Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, will provide you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back to Real Estate 360, your number one source for all of your real estate needs and education. We're broadcasting from the number one business radio station in the San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom Wilson, your host for the Wednesday edition of the Real Estate 360 that comes to you daily Monday through Friday at 3 p.m., along with co-hosts Joe Kuchera and Laurie Graymont. If you can't make the live show, you can catch your podcast on RE360Radio.com, and you can catch my programs on TomWilsonProperties.com or on iTunes under Wilson Investment Properties. At the end of the program today, I'll give you Tom's top tip of the day, but we have just a great program for you that I think is very important to everyone and is often missed in the press and other sources. We have with us in our studio today Russell Gray, who's the co-host of the Real Estate Guys radio show, the number one downloaded broadcast and show on real estate investing. And it's so great to have him here. We are going to talk about macroeconomics in real estate and where we're going and what you should do about it. Pretty critical subject. Russ has been co-host of that show for about 12 years and a partner in the Real Estate Guys. They are sponsors of the famous Summit at Sea, which just had its 11th annual conference. Russ is a very experienced lender in the real estate business and a great educator as well. Russ, it's wonderful to have you on the program.
Thanks, Tom.
Russ, I think I want to let people know that this conference we just had is really was really significant because it had three economists on it who are nationally known. We'll get to them later, but this year's Summit at Sea, which is a conference for real estate investors but has a little broader scope to it than that, you selected as the theme kind of macroeconomics and how it affects real estate. Why did you choose to do that this year?
Well, having come out of the mortgage business and been very active in real estate investing all around the country, I was hit, like a lot of people were, by what happened in the whole financial meltdown, starting with the subprime mortgages, growing out from there to regular mortgages, and then really the credit markets altogether, and this unprecedented collapse in values. And after going through that, it occurred to me that my first reaction was, hey, nobody could have seen it coming. It was just one of those things. We decided to go to the beach one day, didn't check the weather report. The tsunami came, wiped us all out. Nobody's fault. But, after studying it for a little while, I started finding these guys out there that had really said, hey, we saw it coming. A lot of people claimed it after the fact, right? But I found a guy that wrote a book in 2006 predicting it for the right reasons. And he re-released the book in the wake of it. And going through and saying, okay, this is what happened. This is what I predicted. Now this is what actually happened. And the accuracy was just ridiculous. And so it started me on this journey of really wanting to understand the macroeconomics behind real estate, because so much of what you see on financial channels on TV is really about the stock market and the bond market. Sometimes you get a little bit about commodities, and you really don't get a chance to hear it from a real estate investor's perspective. And so for the last 3 years, been studying that. Through the course of doing that, we had a chance to do some interviews with some really prolific authors in the space and speakers and teachers and guys that really knew what they were talking about. And the big question was, could we aggregate all these big brains, get them on the ship, and have them to ourselves for a week? And I'm happy to say that we pulled that off last month, I guess it was, and it was fabulous.
It was fabulous. It's one of the greatest education events I've ever been to. People ask me about the Summit at Sea that I've only been going on for 2 years, and I tell them, well, I've been to a zillion conferences all my life in 2 different careers, and this is one of the most information content and best relationship building experiences I've ever had.
Yeah, I mean, I think the lesson there is that you have to get out of your comfort zone in terms of the way you think. And the best way to do that is to rub your brain against other people's brains. And the problem is so much of our interaction today, even through social media, we're very connected, but we aren't very deep. And so when you get out of your environment and you put yourself in a place where you're going to focus on a subject and you're going to get a lot of different perspectives and you're going to get highly intellectually stimulated, but it's not run from one thing to the next. It's let's do the seminar during the day. Let's have dinner together at night. Let's go out to the beach and talk more about it. And you're around 100 or more like-minded people, and people really from all over the economic spectrum, from all over the globe, and from different educational backgrounds. And when you get a chance to be around those folks and get their perspectives, like Real Estate 360, right? You get this big view of the whole thing. And when you can see the big picture, you can make better investment decisions at the local level.
You know, you can go to a conference and hear a lecturer or a speaker and then get a little Q&A afterwards, and then that's it. But often I find when that happens, I go home and I start thinking about it and I say, gosh, I wish I'd asked him this, or I wonder what he thinks about this.
Right.
So in this case, you have 8 days to go back and do that, and it's really terrific. Let's introduce to the listeners the three economists that you had on the summit this year.
Sure. Well, the guy that we were talking about wrote a book called Crash Proof 2.0. That's Peter Schiff. Peter is the CEO of Euro Pacific Capital. He is really he favors international stocks, dividend-paying stocks. So he's really not a real estate guy, but he is a great economist. And, again, I just judge a guy by his track record. I don't care how many letters he has after his name or what fancy school he went to. I just want to know in the real world, can he make the call? And my experience in listening and watching Peter for the last few years has been the guy is pretty smart, pretty spot on, and a whole lot more fun than I thought he would be. Really a fun guy.
He had a good time, too.
He had a great time, and his wife was lovely. They're expecting their first child. And in fact, I just talked to him last week, and he told us he's coming next year. So we're going to get him back again, and that's good because he's got more information in that big brain of his than we could pull out in just 1 week. The other guy we had was Dr. Mark Skousen, and Dr. Skousen has been around for quite a while. He writes a newsletter. Again, he's a stock guy, not a real estate guy. So again, this is the concept of opening your mind up to other perspectives. He is not quite so fearful or doom and gloomy as Peter is with his concerns about the Fed, although he's got his concerns. He favors domestic stocks, and he invests for capital gains as opposed to dividends, but he does promote dividend-paying stocks as well. Dr. Skousen was recently named in the top 20 most influential living economists on the planet. And every year he runs a big conference called Freedom Fest, which is kind of this free market, libertarian, not quite libertarian, but pretty close event that happens in Las Vegas. We've covered that event through the Real Estate Guys radio show for the last, I think, 3 or 4 years. And it's really well done. Lots of debates, lots of intellectual stimulation, a lot of fun, a lot of great exhibitors. It's spread out over 4 days, so plenty of time for you to visit everybody and learn everything. We do it every year, and there's very few conferences that we attend every year faithfully, but it's one of them.
And it's in Las Vegas, and I think this year it's in July, is it?
It's in July at Caesar's Palace. I think it's right around the first week. It's the first week after the 4th of July, whatever that is. I think it's July 11th through the 14th or something like that.
And I think this year they're expecting like 3,000, and John Stossel's coming down to do his program there. It'll be his largest audience, I think, ever.
Yep, John Stossel's there. Steve Forbes comes every year. We've had a chance to interview Steve a couple of times there. We've got a chance to, that's where we met Peter originally. We met Herman Cain there and did an interview with him. And we've met many other people that probably aren't household names like that, but extremely knowledgeable in their space. And again, it's not a real estate conference. It's not even really an economic conference. It's really about free markets. And so there's politics, and you have to be able to stomach that. But there's also a lot of economics, and there are a lot of opposing viewpoints, which I think is a very honest way to look at a subject matter. You have to look at all the different viewpoints. The third guy we had was a guy named Robert Murphy, and Bob is a guy that is an academic. So he works in a couple of different things. He does a lot of consulting in the energy space, which was very interesting to us this year because of the big oil find in the Bakken, which I think we're going to talk about a little bit later. But he does a lot of consulting in the energy space. He is a senior fellow with the Mises Institute, which is an Austrian school of thought economic think tank and educational platform. It's the same economic philosophies that both Dr. Skousen and Peter Schiff subscribe to. So if you're not familiar with Austrian economics as opposed to the much more popular Keynesian, a lot of people think Keynesian economics is the only form of economics there is, but there's really two distinct schools of thought. And there's a couple of variations of that, but those are really the two big basic schools. So Bob was there, and Bob was great. And we had the three of them on a panel where we got a chance to debate different issues and hear different perspectives. So hearing a guy that runs a stock fund, a guy that does a newsletter but doesn't do a stock fund, and then a guy that's purely an academic. They all had slightly different perspectives, but they all understood each other's language because they come from that same school of thought.
My sense was that they have pretty much the same fundamental philosophies, but they vary a little bit on the depth and the timing of what happens and how that plays out. We just got a minute here before the break. Let's start to introduce Austrian versus Keynesian economics a little bit, and then we'll go into a little bit more depth after the break.
Okay. I think that the way I explain it to people to keep it super simple is that Austrian or Keynesian economics is really consumer focused. The idea that you've got to stimulate the economy by stimulating consumer demand. So you get a lot of this borrow and spend as the solution to economic malaise. And that's what we're going through right now. The Austrian school of thought is really the opposite of that. And it says that production and savings are the key to wealth. Obviously, I have a bias because I think just common sense tells you that if you make more money and spend less, you're going to become more prosperous than if you borrow money and spend more. But those are the two basic differences. And after the break, we can get more into that if you want to do that.
Okay, let's give a little bit of introduction. We got a little bit more.
Okay, so 70% of the economy, as they say, the gross domestic product of the United States is based in consumer spending. Right? And so they say, well, if we want to grow the economy, we have to grow consumer spending. Look at real estate, for example. People are always saying, hey, if we want to see the economy recover, we have to stimulate housing because they think housing has a causative effect in the economy. Well, I have a different opinion. I think housing is a reflection of a healthy economy. People don't go buy a house to become prosperous. They buy a house because they're prosperous. So if you're working at your job and you have a good income and you're productive, then you go buy a property, right? So it's a reflection of. You can't stimulate someone having a job by convincing them to spend more, my opinion, right? And that's why I think a lot of the stimulus that we've tried over the last 6 years, 5-6 years, really hasn't resulted in the creation of jobs. It really hasn't resulted in prosperity. And so those are the things you have to understand, the difference between Austrian and Keynesian in terms of how they solve the problem.
Okay, that's good. Good intro. Let's continue that as soon as we come back from the break. This is Tom Wilson, RE360 on AM 1220 KDOW.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back. We have with us in the studio special guest Russell Gray, who's co-host of the Real Estate Guys. And we're talking about a very important subject, macroeconomics and real estate. Where are we going and what you should do about it? And we just got started on Keynesian versus Austrian economics, and talking about the takeaways from the recent Summit at Sea conference. So, Russ, let's give the listeners a little bit more input about Austrian versus Keynesian.
Yeah, it's really an interesting topic, and I just want to take a second and kind of step back a little bit, because sometimes real estate investors listen to this stuff. They're like, what does this have to do with me? I don't get it. Well, to really understand, you have to understand how the two philosophies drive the behavior of the people who control the levers of the economy, right? The Federal Reserve, the politicians, the bankers, people like that. And so when you understand that, then you can begin to predict with a fair degree of accuracy the direction of real estate prices, the direction of interest rates, the amount of construction and jobs that are going to get created, some of the things the government may do or not do, and what the Fed is doing. And so that may not make sense at this stage of the broadcast, but if you stick with us, we think over time it'll start to make sense. So one of the basic tenets of the Austrian philosophy is free market. Now, we talk all the time about having free markets, but if I could draw a distinction between Austrian and Keynesian, I would say that Keynesian is a little bit more command and control. The central bank, the Federal Reserve in our system, is very involved in what's going on economically. Now, we think of that as just that's normal. Of course, they've always been involved, just like we think, the IRS and income tax, that's always been there. But these things have only existed for 100 years in a country that's over 200 years old. So for more than half of our existence, we didn't have these institutions. And so the effect that they've had on the economy, we've only got a 100-year history to look at least in terms of the United States of America. The concept of central banking existed, of course, before, and our founding fathers looked at that, and I would make the argument, favored a much more free market system. On the Austrian side of it, and it isn't that it came from Austria, it's that the guy who really kind of codified or articulated this philosophy was from Austria, so it's called the Austrian school, whereas the Keynesian school came from John Maynard Keynes, who was hired by the Fed in the early part of the 20th century as all of this new Federal Reserve system was being put in place to come out with philosophies and guidance towards how this new way of approaching the financial system would work. So on the Austrian side, in the free market side of things, it's really the idea that the market knows best. The market will dictate where capital goes. So if you could imagine you got two guys that are in business, or you got a guy that's in business, you're running a sweater shop, and you're selling pink sweaters and you're selling blue sweaters. And so you order equal amounts of both because you don't know what's going to sell. You open up your shop, and lo and behold, you find out that you sell a whole bunch of pink sweaters and not very many blue sweaters. You're the first guy who knows that the market likes pink better than blue. You're the first guy that knows that. And so you call up your sweater distributor and you say, hey, I want to order more pink. Don't send me any blue. He's the next guy that knows. He calls up the factory and says, hey, start firing up the presses, make some more pink, shut down the presses on the blue. They're the third people that know. Now, then the factory calls up the guy that sells the pink dye and says, hey, ship me some more pink dye. And the other guy says to the blue guy, don't send me anything. So you see how the feedback from the street, from the market, is getting to the people who need to make decisions. And this is the key concept about capital allocation. Now, if somebody were to come in and interfere with that by providing a subsidy, say, for blue, because they say, well, it's really not fair that pink is selling so much better than blue. We want to stimulate the consumption of blue. And so what we're going to do is we're going to provide a tax break for blue, and we're going to provide subsidized interest rates for people that want to finance blue. And pretty soon you get a demand for blue that isn't driven by really what the market wants, but you've manipulated a little bit. In the beginning, it doesn't seem like a big deal, but pretty soon you have pink factories popping up. Blue factories popping up everywhere, blue ink manufacturing and distributing coming online. And then when those subsidies are removed, all of a sudden the market wakes up and goes, wow, we've got all of our capital misallocated. It's over here in the blue when really we've got a backlog of pink. Meanwhile, what happens to pink? Pink gets more expensive. So you can see if somebody opened up a blue factory and people moved there and rented real estate and a factory and houses and put up workers and created a whole economy around blue, and then they removed the stimulus, now all of that capital is in the wrong place. And that creates problems. And the shift when capital wakes up and finds out it's in the wrong place as it goes back to where it should have been to start with, that's where we get these economic disruptions. So that's really the basic concept between how Austrian economics and Keynesian economics affect what's going on in the street.
Good stuff. Good stuff. We have Russell Gray with us, co-host of the Real Estate Guys, and great educator. It's wonderful having him with us. We'll be back in just a couple minutes.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back to today's program where we're discussing macroeconomics and real estate and where we're going and what you should do about it. We have Russell Gray with us, who's the co-host of the Real Estate Guys and a great educator, and we are discussing the different parameters and different factors that are going on in the economy that we need to know about in order to make good decisions about what to do about real estate and other investments as well. Russ, let's talk a little bit about, we've discussed the background, a little bit of Austrian versus Keynesian economics. We've talked about the economists that were on the conference that the Real Estate Guys recently sponsored, the Summit at Sea, Peter Schiff and Mark Skousen and the Robert Murphy. And the things they have in common are that they believe in free markets and Austrian economics. Let's talk a little bit more detail now about the different metrics, different parameters that are going on in the marketplace, about the fiat money approach, about the Federal Reserve, what they're doing, and let's talk about that some.
Great. Well, I mean, there's no way to talk about what's going on in the economy without talking about the Federal Reserve. And different people have their opinions. I've read a number of books on the subject on all sides of the argument. And I've read, books where guys are saying that the Federal Reserve is an absolute necessity and provides a valuable service. I've read books that talk about the Federal Reserve being an evil conspiratorial cartel of international bankers bent on taking over the world. I think you have to read all of that different stuff, and then you have to watch the news and try to figure out what I call clues in the news. What is happening in the real world, and how does that fit into some of these different worldviews? And it gives you a little insight into what you think might be the real deal. One
of the things I love about you, Russ, is that it's clear you're more interested in getting it right than you are in being right. So you really have to look at information from different sides of the picture.
Yeah, I mean that's the key in anything, and this is something that just fascinates me. And you get motivated. Like I said, I got hit pretty hard, and I think I'm a pretty smart guy. I try to pay attention, and clearly I did not have the depth of knowledge to interpret the signals the market was giving me. I mean, pretty hard to see into the derivatives market and what was going on in the mortgage-backed securities and the bonds and some of the shenanigans in Wall Street. But then again, some of the clues were there, and guys who really understood these concepts that we're talking about today, like Peter Schiff, were able to see it coming, and they were sounding the warning alarm. And it's amazing how many of the mainstream talking heads in the financial space were mocking Peter and just talking about what a lunatic he was. And yet, turns out in hindsight, he was 100% right and they were 100% wrong. I just wish I would have realized that 5 years ago instead of today.
And he was right for the right reasons.
He was right for the right reasons. Yeah. And so, my thing was, okay, he's super smart, but, I'm not maybe the dumbest guy in the room. So if I spend some time studying the things he studied, I may be able to get a degree of insight as well. So coming back to the Federal Reserve, which is neither federal, doesn't have any reserves, and it really isn't a bank, which, most people don't understand. They think of it as being part of the government, but it isn't really part of the government. It works very closely with the government, but really that's neither here nor there. Their main purpose in the economy is to control the currency. And the way they do that is they have the ability to expand or contract the amount of money, which isn't really money, it's currency. And there's a difference between the two, which we may or may not get into, that's available in the economy. And the concept with inflation, which is what everybody gets so concerned about when they expand the money supply, is that it creates an environment where you have too many dollars chasing too few goods. So just a simple example would be if you were to take, and we had an auction on eBay, let's say, and we had a dollar. I mean, we had a bottle of water, we were auctioning it off, and everybody had $1 purchasing power in their pocket. The most anybody could bid, no matter how hot it was or what the supply-demand imbalance would be $1. But if you gave everybody $10, now somebody would be able to bid $10 for the same bottle of water. That's too much currency chasing the same level of goods. That's the definition of inflation.
Hold that thought. This is Real Estate 360, KDOW, 1220 AM. We'll be right back.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back. We're fortunate to have today Russell Gray from the Real Estate Guys with us in studio, and we're discussing macroeconomics and real estate and how it affects you, how it works, why you should know about it, and we will get later on to how what you should do about it as far as real estate investing and other kinds of investments. Russ, let's chat a little bit now about see if people can understand better what it is the Federal Reserve is really doing and how that really affects our environment and economic environment and interest rates.
Well, I think we've heard a lot of talk in the news about quantitative easing. And, you know, if you pay attention, everybody's concerned that is paying attention that all this easing is going to create inflation. So you've seen the price of gold, you've seen the price of oil go up. And oil, what goes on in oil in particular as a commodity is of great interest to real estate investors because the lumber and all the supplies have to get transported. It directly affects the cost of gasoline, and all of those costs are built in, those transportation costs. Many petroleum products are there's more than gas, right? There's plastics and all kinds of things that are derivatives, fertilizers that come from petroleum. And then the other thing is tenants. You know, if gas goes from $2 to $4 or from $4 to $8 a gallon, tenants will change where they live in order to have shorter commute times. And that also can affect your real estate. So we pay attention to oil in particular, but a lot of this is happening because of what the Fed is doing with easing. So the big question is, how does the Fed print money, and how can you know that they're doing it? And the answer is through their FOMC, their Fed Open Market Committee. And this is the group that goes in and purchases U.S. Treasuries in the open market. So the way our government works in the United States of America is we spend more money than we take in. I think most people know it's about $1.5 trillion a year. To cover that deficit, they borrow. How do they borrow? They issue bonds, which are government IOUs pledging the full taxing authority of the United States, basically selling the people into slavery, if you will, to the borrower servant to the lender. They issue these bonds. People buy them. A lot of talk about how much bonds the Chinese are buying, and that's interesting. But in 2011, I haven't looked at the 2012 numbers, but in 2011, 61% of all bonds purchased, U.S. Treasury bonds, were purchased by the Fed. Well, the thing that's interesting about the Fed is when the Fed purchases, they write a check against themselves, and their checks never bounce. And until they write that check, that money didn't exist. So if you go back to where we talked about before the break about introducing new currency into the market that didn't exist, we give everybody $10 in the water bottle auction. When the Fed purchases those bonds, all those billions and trillions of dollars that didn't exist before come in. And that's when you hear the talk about the Fed expanding their balance sheet. They're putting more of these assets, which are basically IOUs, on their balance sheet. That introduces new money into the system. People who are paying attention, their immediate reaction is to try to hedge against the devaluation or the drop in the value of the dollar, more dollars being able to purchase the same amount of goods.
Because it's getting diluted.
It's lost its purchasing power, and they leave the dollar and they get into commodities, typically gold, silver. They'll buy copper, they'll buy futures on different types of agricultural crops, oil, lumber, all those things, right? They get into these commodities. Gold and silver, of course, are the typical hedges, and that's why we've seen a big increase over the last several years since the crisis hit. With all the quantitative easing, the reflection has been an increase in the price of gold.
So you mean the Fed doesn't actually run printing presses?
Not really. I mean, not really, but it expands it. It expands it by purchasing these bonds. The effect, though, and this gets a little bit more complicated, is understanding the inverse relationship between bond price and bond yield. So when you bid on a bond and there's more buyers, the price of the bond goes up, which means that the yield, the cash that it throws off, the interest, as a factor or a product of the price, goes down. So more demand for bonds, higher bond prices means lower interest rates. And so people say, well, gosh, where do we get all these wonderful interest rates from? It's from aggressive buyers coming in and buying U.S. government debt. And the question is, well, why is everybody buying U.S. government debt? Well, 60% of it is being bought by the Fed. So I'm not sure that everybody is buying it. The Fed is buying at least the majority of it. And as long as that continues to be the trend, that that is inflationary. Now, that's not necessarily a bad thing, because as a consumer, as a real estate investor, I can go in there, and we're probably not going to be able to cover that in this episode, but I can go in there and I can purchase. I can purchase property using debt, lock it in for the long term, and then benefit from the increase of the value of the real estate over time. And that's probably a bigger topic than we have time for in this segment.
Talk a little bit about deflation versus deleverage and excess supply, if you will.
Oh, that's a great topic. So a lot of people think that, they worry about inflation. They go, oh, I don't see any inflation. Well, first of all, the government's index of inflation isn't really an honest index. They manipulate it because it helps mitigate their obligations under cost of living increases. So if I can create a low CPI, then I don't have to pay people as much. But anybody who's living on fixed income, Social Security or whatever, with these COLA adjustments are realizing their purchasing power is going down.
It's kind of ironic, isn't it? We look at the news and they say, wow, consumer confidence index is up and consumer spending is up, and everybody thinks they're supposed to be happy.
Yeah.
They are.
Well, I mean, a lot of the asset prices we see are really artificial. But back to this concept in real estate in particular. So deflation is when there are less dollars chasing more products instead of more products chasing less dollars. So there's probably nothing wrong with that. Most people think deflation is evil because that's what the Keynesians have convinced us is the case. But, I mean, if you think about your cell phones and things like that, I mean, has lower prices made you more or less technologically prosperous? You've gotten more prosperous, right? Because your dollars will buy you more technology. So dropping prices is actually a boon to the consumer. But in the real estate space, the drop in prices are caused by two things. It's a weak labor market, meaning less people could have jobs and incomes to pledge to mortgages. And you have less people being able to qualify for mortgages and tighter lending. So when you take leverage out of it, there's less purchasing power to drive up the price. But that isn't inflation or deflation, which is about the currency supply. It's more about the leverage, the amount of debt. So one of the leading indicators that we watch to see if real estate is going to start to break out, if you will, would be loosening of lending guidelines. And after several years, I'm here to tell you, it's starting to happen.
Thank you, Russ. We have Russell Gray with us from the Real Estate Guys talking about macroeconomics and real estate. This is Tom Wilson with RE360 on KDOW AM 1220 AM. We'll be right back.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back. We've had a great program with Russell Gray, co-host of the Real Estate Guys, and a great educator. And we are talking about macroeconomics and real estate today. It's a lot to cover, and we've for this segment today, we've really discussed the metrics and the variables and how the economic world works. We've talked about Austrian versus Keynesian economics, Summit at Sea, where we had three great economists that talked to us and taught us for 8 days about their views, and I think everybody came away with a much better feel for it, and realizing that you got to be very very careful about who you listen to, and you got to kind of summarize for yourself what makes sense and what doesn't. See what folks have really track records about what they said coming true. My kind of top tip of the day is be careful what persons with influence tell you. You know, back in 2005, Bernanke said, "We've never had a decline of housing prices on a nationwide basis. What I think is more likely is that house prices will be slow, maybe stabilize. I don't think it's going to drive the economy too far from its full employment path, though." Bet he wishes he could eat those words. But it's not new. You know, here's one president that said, "No Congress of the United States ever assembled on surveying the State of the Union has met a more pleasing prospect than what appears at the present time." That was Calvin Coolidge just before the crash of the Great Depression. So be careful. Be careful what persons of influence tell you, and get your information from certainly more than one source. Like Russ told us, he's read every book you can get hold of about Federal Reserve and try to understand what makes sense.
You know, and as a little kid, we had this game called Mousetrap, you know, back before the electronic games, right? So you had to actually assemble this thing, and the idea was it was this whole mechanical thing. You'd drop a little ball, and it would hit a shoe that would kick a thing down a deal, and then all of a sudden this big chain reaction would occur, and the end result would be the trap would come down on the mouse. And I always use that as an analogy to really understand that when in the economics, there are cause and effect. I mean, things happen in the economy for a reason, and because of that, it is possible to understand how when something happens on the front end, what's going to happen down the road. And of course, that is what you're looking for as an investor. How can I know where the puck is going, to quote Wayne Gretzky? So
we talked about the background and fundamentals in this program. Next week, Russell Gray will be back with us, and we're going to talk about cause and effect. What does happen after certain events take place? What are some hedges and things we can do about it? And that will be a great program to give you some takeaways. And we'll also talk about what are some mitigating factors. We've got some maybe potentially grim news out there, but there are a couple things that are going on that could soften this a little bit. But it's very important for you to be in a position of knowledge so you can make some good decisions. And by the way, if you'd like to attend the Real Estate Guys Summit at Sea next year, go to the Real Estate Guys Radio.
Yep, realestateguysradio.com. Click on the tab that says Summit.
And if you and this program and others can be heard by going to TomWilsonProperties.com and looking at the podcast or on iTunes. And the Real Estate Guys Radio have a wonderful guest every week as well that you can go tune in on them. So thanks for being with us. It's been a great program. Thank you, Russ, for being with us. Look forward to having you back next week, and we'll start talking about what we do about this and where maybe it's headed. This is Tom Wilson, Real Estate 360, your host on KDOW.
You've been listening to Real Estate 360 on AM 1220 KDOW. For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. AM 1220 KDOW.